Well, four of Canada's big six banks have now reported. We're going to recap the numbers so far. New and young Canadians, they are driving the growth to $2.4 trillion of consumer debt. We're going to look at another deal in the massive oil sector, and the Gildan saga appears to be nearing an end. Today is Wednesday, May the 29th, 2024. Let's get started with today's top stories. All of Canada's largest banks now, with the exception of RBC and CIBC, they've reported their Q2 2024 earnings. Now, analysts had predicted a potential 4% year-over-year drop in earnings. They are expecting slower profit growth overall. And what we're seeing is that the earnings with the banks have in fact faced higher costs, increased reserves for potential loan losses in most cases, and they've been maintaining stronger capital requirements. So we're going to look at what's come in so far. I want to start with TD Bank. Total earnings, $2.56 billion or $1.35 a share. That's down just over 22% from $3.31 billion or $1.69 per share last year. Adjusted earnings per share, $2.04. That beat analysts' expectations of $1.85 a share. On provisions for credit losses, they came in at $1.07 billion. That's up almost 80% from the $599 million we saw a year ago. The bank has maintained its dividend of $1.02 per share. Bank of Nova Scotia reported total earnings of $2.09 billion or $1.57 a share. That's down just under 3% from the $2.15 billion we saw a year ago, $1.68 per share there. Adjusted earnings per share are $1.58. That beat analysts' expectations of $1.55. Provisions for credit losses, we saw $1.01 billion. That's up about 63% from the $621 million we saw a year ago. Dividend per share, again, maintained at $1.06 per share. Up next, Bank of Montreal, total earnings $1.87 billion. That's $2.36 per share, up 81% from the $1.03 billion we saw a year ago. $1.26 per share in that case. Adjusted earnings per share of $2.59. That missed analysts' expectations of $2.77. Now, for provisions for credit losses, they booked $705 million. And in a rare change from the other banks here, that's down 31% from the $1.02 billion a year ago. As far as dividend is concerned, they upped the dividend by 4 cents to $1.55 per share. And lastly, on today's report, National Bank, the total earnings came in at $906 million. Or $2.54 a share. That's up roughly 9% from the $832 million we saw a year ago, or $2.34 a share. Adjusted EPS, $2.54 a share. That beat analysts' expectations of $2.42. For provisions for credit losses, we saw the bank book $138 million, up over 62% from the $85 million they booked a year ago. Dividend, $1.10 per share. That's up by 4 cents. Now, I will bring in the numbers for RBC and CIBC on my next update, and then next week I'll provide a full recap of all the banks with some commentary there as well. A new report by TransUnion shows that there's an increasing number of Canadians only making minimum payments on their credit cards. And the report says that the trend is being driven by cost of living crisis and rising interest rates, which are putting additional strain on household budgets. The percentage of Canadians who are paying only the minimum amount on their credit cards went up to 1.3% in the first quarter, and that's an increase of 8 basis points from the previous year. Matthew Fabian, he's the Director of Financial Services Research at TransUnion Canada, and he highlighted the impact of inflation and higher interest rates on household incomes. He says consumers that have had significant increases in their mortgage payment have made that deliberate trade-off to pay less on their credit card, and in some cases, they're missing their payment. And this has led to higher delinquency rates in credit cards for those with mortgages compared to traditional credit card users. The report also detailed the rise in total consumer debt in Canada, which has now reached $2.38 trillion in the first quarter. Small bit of good news, I suppose, is that is actually down ever so slightly from the record $2.4 trillion we saw in the fourth quarter of last year, but higher than the $2.32 trillion that we saw in the same quarter of 2023. The number of Canadians with one or more credit products, that increased by 3.75% year over year, driven mainly in this case by newcomers to Canada and by Gen Z. Notably, Gen Z saw a 30% rise in outstanding credit card balances compared with the previous year. Fabian also commented on the debt distribution amongst different generations. He points out that millennials hold the largest portion, about 38% of all debt. And on this topic, he says they're in the life stage where they're probably having children, getting houses, and auto loans. Now, despite these concerns about the missed payments, Fabian does say that he remains optimistic, and he says that we're seeing still pretty decent resilience in the Canadian consumer base. He also notes that the anticipated interest rate cuts, should they come, would obviously alleviate some of the financial pressures on households, and he says that this would help to correct the market back to normal levels, but he does stress that would happen over time. In this challenging market environment that we're facing these days, anytime that you have a chance to gain a deeper understanding of investment strategies sure would be welcome. Well, you can join renowned investor, Wharton Professor of Finance, and acclaimed author Jeremy Siegel, alongside Michael Kovacs, who is Harvest ETF's president and CEO, for an overview of the current economic landscape that's influencing the stock market. Professor Siegel, he will discuss the impact of global economic shifts on stock performance. He will forecast movements in interest rates and inflation, and outline strategic investment approaches as we move towards the 2024 elections. And during the session, you're going to hear how some experts are navigating the markets in volatile economic climates. Reserve your spot now. Space is limited. I will put a link in the description of this video. Now, last summer, we visited 4 Canadian cities to meet and greet with our Investing Academy students and with Blossom Social members. We met over 1,000 of you last year. We're looking forward to meeting more this year. We are currently gearing up to hit the road again. So for those of you who couldn't make it out last year, I would encourage you to sign up for one of our events. They really are a fun time to get together. Quick note, we did sell out the venues last year. They all have limitations on sizes. I'll expect the same thing will happen this year. Now, we will be in Toronto, June 25th, New York, June 30th, Montreal, July the 2nd, and then we're booked in Calgary for July 15th and Vancouver on July 18th. And this year, we're probably going to be joined by 15 or maybe even 20 creators that you're probably familiar with. For example, Adrian, who's better known as the Canadian in a T-shirt, he'll be there. Shay, also known as the Humbled Trader. Zach Hartley, Instagram and TikTok phenom Joy Yi Yang will also be along. Many others depending on the location there. So if you are a DIY investor, I would highly encourage you to come out, hang out with us. I will put links in the description of this video. ConocoPhillips has agreed to acquire Marathon Oil in a $22.5 billion all-stock deal, and this marks just the latest merger in this burgeoning oil and gas industry right now. We have seen a flurry of mergers and acquisitions recently, with $250 billion in deals just last year alone, and the trend is obviously continuing here as U.S. oil production reaches new highs. This offer, it values Marathon Oil at $30.33 a share, which is a 15% premium based on Marathon's closing price on Tuesday. The transaction includes $5.4 billion of Marathon's debt and is expected to be finalized in the fourth quarter of 2024. Now, this merger is expected to bring around $500 million in cost savings within the first year after closing. So those are pretty substantial numbers there. Also, it will add over 2 billion barrels of reserves to ConocoPhillips' portfolio. And Marathon's assets, they are seen to be particularly attractive because of their low cost supply and their high quality inventory. So ConocoPhillips CEO Ryan Lance, he said, "This acquisition of Marathon Oil further deepens our portfolio and fits within our financial framework, adding high-quality, low-cost of supply inventory adjacent to our leading U.S. unconventional position." So, of course, Conoco is already a major player in the Permian Basin. This deal will see its production from the Eagle Ford Basin surpass actually its legacy assets in the Delaware Basin post-merger. As I mentioned earlier, this deal is just following a bunch of other pretty significant moves in the oil patch. We're talking about ExxonMobil's acquisition of Pioneer Natural Resources, which closed earlier this month. Chevron's proposed $53 billion merger with Hess, which just received approval from Hess shareholders yesterday. That deal still requires regulatory approval, and it will have to work through its arbitration with ExxonMobil and CNOOC International. Also, this wave of consolidation has caught the attention of antitrust regulators, and the FTC, the Federal Trade Commission, it's reviewing several multi-billion-dollar deals in the industry, including those involving Chevron, Diamondback Energy, Occidental Petroleum, and Chesapeake Energy. So despite these potential challenges here, ConocoPhillips, in this case, it does plan to dispose of $2 billion worth of assets and increase its share buybacks to about $7 billion next year, with an additional commitment to repurchase $20 billion worth of shares in the next 3 years following the merger's completion. Gildan Activewear held its board election on Tuesday, and CEO Glenn Chamandy, he received around 84% of shareholder votes to rejoin the board. And the company also reported that the other 7 nominees received strong support, with approval levels ranging from 83% all the way up to 99%. So very strong support there. For those of you who aren't quite up to speed on this, last year Chamandy was kicked off the board around accusations that questioned his capability to even lead the company. Vince Tyra replaced him, but that led to a battle with activist investor Browning West. And in this case, they, along with the support of Gildan's largest shareholder, Jaroslawski Fraser, they pushed for Chamandy's return. Last week, Tyra and the company's board all stepped down quite unexpectedly, and that then paved the way for Chamandy's comeback in the election of the new boarders that were, as I say, nominated yesterday by Browning West. In addition to the board election, Gildan shareholders also voted on executive compensation, which received about a 74% approval. If you have not already subscribed to our Pulse newsletter, I will make that very easy for you to do. I'll add a link in the description of this video. I'm here on Mondays and Wednesdays with this report. As always, thank you for watching this video. We'll see you next time around.